Welcome to this week's strategy session. Thanks for joining me. Great having you with me for another edition. Not a live show this week. I'm pre-recording over the Christmas New Year period. So back to live shows in 2 weeks' time. Nonetheless, lots of interesting stuff to go through. Some movements in the local market, in the ASX 200 and the S&P 500. We've also got the commodities to have a look at as well. So I think we've got lots to go through. As always, everything today is general commentary only, doesn't take your personal situation into account. And having said all that, let's get straight into our charts for the week. So the first chart up here on the screen is the ASX 200. And what we have, so 2024 has been the year of the bull market. Prices have spent much of this year above these rising moving averages. And you can see the two moving averages I'm using. I'm using a 50 and a 100-day moving average. But the market structure, well, is it starting to change? That's what I want to look at today. I'm also going to look at the US markets. What's going on with the S&P 500? I think there's some big shifts that I want to show you. And I think they're a really important thing to be aware of as we go into 2025. But first of all, just looking at this local market, the ASX 200, and after 3 weeks of selling, the market looks like it's going to close this week, this holiday shortened week, with a gain. And the last time the ASX 200 had a 3-week sell-off, it was back over here in March, late March, heading into April. There was a 3-week sell-off, similar to what we've had just recently, a 3-week selling phase. And like the current one, prices briefly broke below the 100-day moving average before rebounding. And this week's rally, going back over to this week's rally is also coming off this support region in here around 8,100. At this stage, the structure here does remain bullish. It is under pressure with this move below the moving averages. It does put the bullish structure under pressure, but at this case, the structure does remain bullish. What I'm watching is how prices trade now. They're getting back towards these moving averages. We had the dip below. Now prices are getting back to them. And this is an important time, how prices behave now they're getting back to the averages. The risk is that prices stall now they've come back to the averages. The risk is that they stall, start to consolidate below the moving averages, and then that potentially creates, well, that would create a point of vulnerability. If prices consolidate below moving averages, it's generally a point of vulnerability. And it would also be a significant structural change. So all of this year, it's been about prices being above rising moving averages. And should the structure change and prices start to consolidate below moving averages, which may also start to roll over, that leads to that change, which I think is important to be aware of. And then that potentially leads to an even larger pullback should we see that change take shape. So all year, as I say, it's been about consolidating above rising moving averages, and now we're faced with the potential of prices consolidating beneath moving averages. So very important possible change to be aware of. That hasn't happened yet, but I think it's important to be aware that window of possible structural change is very much opened at present. And this is just one of those times where I think we really do need to remain flexible and be willing to adjust our portfolios as this price action evolves over the days and weeks ahead. I'm prepared to give the this large upward trend over the last 12 months the benefit of the doubt, but I don't want to understate that there is risk with this current sell-off. The sell-off, it does create a fair amount of technical damage, and I won't be surprised if the ASX 200 is maybe several weeks or several months of consolidation prior to possibly seeing this upward trend resume. But do be prepared, I think, that this does take a bit of time to play itself out. As I said last week, I think the way to approach this is cautiously. I'm not in a hurry to buy this dip at present. The dips I like to buy are when we see prices dipping back towards rising moving averages, and the price generally remains above the moving average. I don't buy a dip when it's below the moving averages. We're getting back towards them at the moment, but nonetheless, I still think it's worth taking that cautious approach, given some of the technical damage that has been done. And I'm happy to stand aside when we get these sharp declines. In regards to the stocks that I own in my own portfolio, I think the play is to give them room to move with the aim of seeing off this pullback. So I am working on the basis that this is a corrective phase to an ongoing bull market. So I want to give that stance the benefit of the doubt, give my stocks room to move, hopefully see off a pullback. But that said, I do know my exit levels should this current situation worsen and prices sell off. Know the exit point. I think it's a really important way to approach markets. Now, I'm going to jump over to the US market now, but first of all, if you're getting some value, please hit that like button, leave a short comment, just, hey, thanks for the video. It tells YouTube you're watching, YouTube shows other people. It helps me heaps. Please do those things. Now, let's go over to the S&P 500, because this is really, really interesting. So we've got this strong rebound over the last few days off the moving average region, an area between the 50-day and the 100-day moving average is where this rally has begun from. And this is how several rallies to all-time highs have begun this year. So you can just look back and see several times where there have been these strong rallies off the moving averages have led to new all-time highs. And I think there's every chance that that same sequence continues this time around. We still have rising moving averages, the 50 and 100 day. They continue to rise. Prices is above those moving averages. So from that perspective, the bullish trend remains very much intact when we look at the S&P 500. The concern I have with the US markets, it's not when we look at the S&P 500 index on its own, but when we look elsewhere, when we look at other parts of the market and other ways to look at the S&P 500. And because as we know, the S&P 500 is dominated by a handful of those big tech stocks, but there's a whole lot more to the market than just a few of the big companies. I'll show you what I mean. I'm going to jump over to the S&P 500 on an equal weighted basis because it gives us a very different perspective. And so this is when we line all those 500 stocks up and we rank them equally. And we look at them equally. This is what the S&P 500 looks like. So it's quite a different structure what we've seen in the index itself. And we've been watching this decline over the last few weeks. And this has been the warning that there's possibly a shift occurring in the broader market. Now, I've been watching this rebound off Friday's low. So last Friday, it's only a few trading days this week. Of course, there's been several days of holiday. So last week, I've been watching this rebound off there. So far, I describe this as a lackluster bounce. There really hasn't been too much to it. It's struggling to get a foothold back above the 100-day moving average, at least at this point. So far, the buyers aren't lining up to buy this market. It's not a dip that we're seeing a great deal of interest in buying, at least not yet. So the concern I have is the same one that I described for the ASX 200, and that is that that prices start to consolidate below moving averages whilst these moving averages are rolling over. So the type of price action that I'd be concerned about is if we see price action like this over the next few weeks, where that bounce doesn't really get too far, really gets stuck beneath the averages, and then that creates a vulnerable structure, which can then lead to further weakness. So this isn't the price action we have at the moment. It's just the price action that I'm looking for and would be the alarm bell that maybe there is a larger decline coming. But we need to wait and see. If we do get a strong bounce off current levels, well, maybe that's not the concern. It's if this bounce remains lackluster, doesn't really get much altitude, that's when we start worrying about that vulnerable situation, which isn't there yet. As I say, it's what we need to look out for. And I think that's how structural shifts occur. So watching for that price action. It was also really interesting to read this morning that according to the latest Bank of America Global Fund Manager survey, so they do a monthly survey amongst all the largest fund managers, and what they've found in that latest survey is that funds are holding less than 4% cash. So that's an historically low measure when it gets into the 3%. That's where it currently is. I think it was 3.9% I read. So anything below 4%, it's at the lower end. And often when cash levels are low, it does create a layer of vulnerability to the market in that a lot of cash is already in the market, and it can become susceptible to any shocks that causes money to come out. I think this increases the risk that we do see a trend pause, particularly what we're seeing in the equal weight. From a positioning perspective, with a lot of money having already come into the market, uh, I think that it does raise that possibility or that vulnerability to the market. Last week we spoke about money coming in after the election, and look, a lot of that money now is sitting at a loss because markets have come back to pre-election levels. And I think this could create an overhang of stock as this money is somewhat trapped at higher levels, and that could cap prices heading into the new year. So, like the ASX 200, I'm not rushing to buy this dip. I want to give the underlying trend the benefit of the doubt. We still do have this underlying trend. It's under pressure, but I'd still give that the benefit of the doubt. But I do want to be aware that there is an overall deterioration in the price action, and I do think we need to carefully manage risk at this point. For me, it's trailing stops on my stock holdings, and a cautious approach to buying. I only want to consider the stronger setups, and I'm happy holding a bit of extra cash at the moment, unlike a lot of those fund managers. So that would be the way I'd be approaching this. Now, I'm going to jump over to look at the commodities in a moment. But of course, that wraps up the free section. If you're not a strategy session member, there's a link below. Click that, come on board, have a look at the rest of the strategy session. A lot of interesting things to go through, and I think you get a lot of value for very little money. So, okay. Let's having said that, let's have a look at the Russell 2000.